Thank you, Mr. Chairman. As I said before the break, I'd like to call my next witness, Mr. Rodney Crett. Mr. Crett is well known to the commission, but I'm going to go ahead. If you would mind, Mr. Crett, could you please give me as short as possible, but a description of your background in the valuation, ad valorem taxation field, your education, and your certifications.
Thank you, Commissioners. My name is Rodney Crett. I work with Pritchard & Abbott, valuation consulting firm in Fort Worth, Texas. We represent here today the three parishes, Caldwell, Jackson, and Franklin. I have a petroleum engineering degree from A&M way back in the last century.
Which A&M?
Texas A&M. Thank you.
Sorry.
And have trying to be brief, Brian.
That's why I cut out Texas, just hanging out.
I'm sorry.
And I've been in the property tax appraisal world ever since, working for either the government on the appraisal side of the business or for oil and gas industry as a property tax agent. That was a brief point in my career. I left Pritchard & Abbott to go work as a property tax agent and then came back to PNA after 5 years. I've been working in Louisiana for 20-something years. I've lost count. It was somewhere back from 1997 to now, 22 years. And been coming over here offering testimony in rules and regulations proceedings for about 15 years or so on various chapters, including Chapter 13 pipelines. And that was probably the reason I was asked to be here today, was if we wanted to talk about Chapter 13 in some respect, the building of the replacement cost need schedules in that chapter, or the depreciation components of that chapter.
And licenses, certifications.
In Texas, where we're required to be licensed through the state of Texas, I have a registered professional appraiser license, RPA, which allows me to work in the appraisal world for appraisal districts in Texas, much like county assessors here in the parishes of Louisiana. That's been a constant since 1983.
And you have testified before this commission before, have you not? And given testimony regarding valuation and appraisal information?
Yes, I have.
Okay. You sat through the earlier testimony of Mr. Smith and Mr. Riley, did you not?
Yes, I did.
Tilwood, just for the sake of efficiency, I think I'm going to kind of adopt their model. And I'm just going to turn it over to you and see if you can give us, again, a brief summary of your thoughts on their testimony, their procedures, and the propriety of using book value as a proxy for fair market value and ad valorem taxation.
That'd be fine. One thing I'm not going to do today is offer you an opinion of value, because I have not been asked to provide one for our clients. We don't work for any of these three parishes in the appraisal of the pipeline accounts for Regency. We do work the value for the Canyon compressor station, which is also at issue here today as part of the assets, the PP&E that has been talked about today, and that's in Caldwell Parish. Book value versus market value. Very interesting subject always. When we do appraisals in the property tax world, we're looking at the definition of fair market value. And the definition of fair market value is pretty well generally understood and pretty consistent throughout the states. Usually involves a willing buyer, willing seller concept. Open market, which means the property has or could be marketed, should be marketed for all to look at for a sufficient number of time for all market participants to find the property, to be aware of all the uses of the property, the exigencies of the property, what goes along either good or bad with the property. In other words, an arm's length, what we call an arm's length transaction. There was an arm's length transaction for some of the units involved here, the general partnership units involved with this partnership. One partner did buy the other partner out. I have no idea how well that was marketed, how Linda marketed their shares of the corporation. I can't speak to that, or the company, I mean the partnership. Can't speak to how long they tried to find any other buyer besides their other partner in this Regency pipeline. I assume it was the 50% interest that's been referenced here, but I've just looked at this for the last couple of days, so I don't have a deep background in this particular pipeline itself. Book value is an accountant's version of fair value. At any point in time, we usually look at balance sheets that have this cost, historical cost or original cost or acquisition cost, depreciated to a net book value. And that's fine as far as an accountant's opinion of value. That can come into play in how an appraiser for property tax purposes looks at property. For instance, when we're doing, when the LTC does public service pipeline unit appraisals, they're looking at balance sheets and coming up with a concluded opinion of value or indicated value by that particular cost approach, the accountant's cost approach, but they're also looking at the income potential there. It's very rare, in my opinion, that book value equals market value for a host of reasons. The depreciation that was discussed briefly is one of those reasons, maybe even the primary reason, because of the way that accountants apply depreciation is different from the way that appraisers look at it from a fair market value standpoint. We're looking at what the market believes the depreciable amount is, where accountants, when they're putting their books together, their balance sheet items, they're trying to do that for a different purpose. Much of the time, if it's a publicly held company, for SEC reporting for income tax purposes.
Now, how about in this case where the book value is heavily driven by an impairment write-down for anticipated future losses?
I don't see these impairment studies very often, and I don't know how often they're actually done. There was a question today about how often it's been done here for Regency. There's no doubt that the natural gas industry right now is hindered in lots of ways due to the low commodity price. That puts pressure on all ends of the business, including the pipeline end of the business, the midstream part of it, the transportation. In this particular case, you do have some contracts that are take-or-pay style. There are capacity reservation fees as well as the actual transportation fees for what does move through the pipeline. And those are interesting animals in and of themselves. Different companies have different ideas about how to structure those, what percentage. We heard a big percentage right now is for the reservation capacity. Those do change over time. Those long-term contracts can, they do have a term. They're not forever term, they're just long-term. Eventually they will run out and new contracts will have to be made with either the same shippers, the producers, or different shippers if there are any available to them. I think you've already heard testimony today that things change over time. These pipelines are built with many decades worth of life anticipated. Certainly the Haynesville Shale was started to be drilled in around 2005 or so, 2007, and ramped up at a time that gas prices were quite a bit higher than today. Has that changed the income being recorded on the books, the operating income being recorded for Regency over the last 10 years? I've been looking at these last 2 years given to the assessors under the consolidated income statements. And
again, you're referencing the Grant Thornton financial statement that was one of the 3 documents provided to the assessors by Mr. Smith on behalf of Regency and Trustee Gas?
Yes, and specifically page 4, where there's the consolidated income statement for the 2 years prior to January 1, 2018. 2016 and 17. 2016, I'm looking about halfway down the page where it says operating income or loss in parentheses. Operating income was $87 million as booked for calendar year 2016. And then for calendar year 2017, the operating income was $61 million if you don't count the one-time impairment expense of $370 million. The impairment expense is not something I see very often in the appraisal for the property tax appraisal world. It's an interesting concept, just like you mentioned, or how I heard it earlier in testimony. That is an accounting, it's not an out-of-pocket expense. And talking about out-of-pocket,
Well, Joe, before you had mentioned, these figures on page 4. Were you able to calculate an effective rate of return if you exclude the impairment expenses?
yes, I did that just for fun. I had looking at, these are all before income tax figures, because this is a limited liability company that's under MLP, non-income tax paying type of financial structure. I calculated in 2017, looking at the $61 million, $61,184,686, divided by the balance sheet, property, plant, and equipment. That's a return on assets, or what I call a rate of return, 13.9%. That was for 2017.
So for the year immediately preceding, again, we're talking about 2018 taxes calculated as of January 1st, 2018, they earned a 13.9% return on those assets?
Correct.
Okay, thank you. Proceed.
And the year before was 12.4%. So it's actually higher in 2017, but that was due to the fact that you had a lesser number in the denominator of that calculation, a written down cost figure. I wanted to talk just very briefly about page 6 of this same report, consolidated cash flow statements. That page 4 was a net operating income. Page 6 gives you another way of looking at income, which is cash flow. And that's different because that's measuring actual out-of-pocket expenses versus numbers that may be just accounting entries only. And about halfway down the page, you come to net cash flows provided by operating activities. And in 2017, that number was right at $97 million, $96,856,740. And the year before, 2016, it was 107. So I think 107 billion. So I think what you're seeing here is that those long-term contracts, they're still in effect, and they will still be in effect through February 1st of 2020.
Can you turn to the Energy Transfer Partners, the Pricewaterhouse Cooper ASC 350 and 360 impairment analysis? Do you have any comments on that based on the testimony you heard earlier?
I do have a few comments on this. I read this whole thing in detail over the last few days. It's a fascinating report. I heard testimony today that this was an independent study. And I don't find anything independent about this study. Throughout this whole report, you look at the assumptions of limiting conditions, caveats they have at the end, you come to see pretty fast, it's repeated over and over again that this discounted cash flow analysis that was performed to come up with this fair value by PricewaterhouseCoopers relied exclusively on economic forecasts provided by their client, which was Energy Transfer Partners. There was no independence in that as far as I could see. They did do a very good analysis on their cap rate, or their discount rate that they used in there. And I think overall it's a fine report as it is, but in my opinion it's made as instructed. I think the number was going to come back to $440-something million for TP&E, $446 million from the start. I think that's where it was headed from the start, because it was all based off of Energy Transfer's internal economic forecast, which Pricewaterhouse took at face value.
And PricewaterhouseCoopers did not audit those numbers?
In fact, it specifically says in here that they did not audit those numbers and they did not verify in any way those numbers. It just says that they didn't have any reason to believe that the numbers were not accurate. I also found that the language, which has already been in testimony today, pretty fascinating, how this report was not meant to be used for any other purpose. And in fact, it even says in there that there should be explicit written permission to even use the report for any reason. or to disseminate it to any other party.
Mr. Craig, did you have an opportunity to look at the purchase and sale agreement between Olinda Gas Pipeline 1 LP, Olinda Gas Pipeline 2 LP, and Regency Haynesville Intrastate Gas LLC?
Well, unfortunately, it's the first time I've ever seen this particular purchase and sale agreement.
Oh, it is?
Yes, it is.
Oh, so you've not had a chance?
All I know about the sale is what's been presented in testimony today.
Okay.
What the assessors were looking at.
Okay. Well, tell us, give your opinion on, based upon the testimony you've heard today, as to the validity of this sale of general partnership interest as an indicator of fair market value for pipeline assets.
The rules and regulations do state that sales, if they're valid, can be used as a measurement of economic obsolescence. First thing I noticed about this sale is that it was after January 1 of 2018. This is a January 1, 2018 appeal hearing, so I'm not even sure why this is submitted as valid evidence to begin with. It was well after. April 10th, 2018 was the closing date of this sale. I tend to invalidate sales right off if they all at least meet somewhere before, if they close somewhere before the lien date, the as-of date of our appraisal. Other than that, I understand the reason of the sale, or the numbers in the sale. $25 million for reportedly 50% of the equity interest. 25 million times 2 gives you up to $100 million for total equity interest, and then $382 million that reportedly is the rest of the liabilities that you would add to the $100 million, get you up to the $480 million, somewhere in the neighborhood of this number that Property Tax Partners is recommending to you today. I understand all that. I just have questions about, first of all, the arm's length nature of the sale, the timing of the sale, and we also don't have, I think it was pointed out in testimony today, we don't really have a list of what other liabilities there are besides the $382 million note that was due, I guess, December 31st of 2018.
And did you hear the testimony earlier that, and I quote, Olinda really wanted to get out? Would that be, how would that play into your concerns or questions about this being an arm's length transaction?
Well, it gives me pause, but I really don't know what their motivations were, one way or the other.
Is there anything else you would like to add, Mr. Pratt? My next question, I'd like to call Assessor Rod Elrod from Franklin Parish. Good afternoon, Mr. Elrod. Kind of covered your introduction, but you are in fact the assessor of Franklin Parish, are you not?
I am.
And you were the assessor of Franklin Parish for tax year 2018, were you not?
I was.
You were in for the earlier testimony regarding this matter. In that testimony, Mr. Smith identified 3 documents that he had provided you in support of Riggs' request for a reduction of value for obsolescence, and that was an audited financial statement, an impairment analysis from PricewaterhouseCoopers, and a purchase and sale agreement from Olinda Gas Pipeline 1, Pipeline 2, and Regency Haynesville Intrastate Gas LLC. Are those in fact the documents you received?
Yes.
Did you receive any other documents from them?
No.
In support of the request for obsolescence? You did not grant the requested 31.04% obsolescence, did you?
No.
Now, did you, before you declined it, did you review the documents that they had provided to you?
Yes, very much.
In your opinion, did they constitute sufficient evidence of a loss, again, for the tax year at issue?
They did not.
Tell me real quick, your concerns about these documents. Again, the sale, the purchase and sale agreement, the impairment analysis, and the financial statement.
Well, the sale agreement was hard to make good sense out of.
What do you mean by that? You couldn't determine what was being purchased?
What was being sold, what was being purchased. Also, $25 million to acquire $380 million in liabilities. On the Price Waterhouse document, I found it odd that we would write down $370 million when nothing on the ground had actually changed.
Okay, and again, the assessments at issue were determined as of January 1st, 2018, correct?
Yes.
In your opinion as assessor, again, the duly elected assessor of Franklin Parish, does the fact that that Regency Intrastate Gas is going to be potentially suffering a loss in income because contracts will be canceled in 2020, does
That has no role in assessing for 2018.
Thank you. Mr. Smith testified earlier that he had an opportunity to speak with you prior to the open books periods.
Yes,
You
he
recall
did.
those conversations?
Yes.
And at that time, I assume he presented the 3 documents we just discussed.
He did.
Can you tell a little bit about your conversation with Mr. Smith, what he told you, why he believed
Well, he
obsolescence was warranted?
he mentioned the future contracts that were going to be expiring in 2020. He said that investors were not realizing their requested or anticipated rate of return. Presented the sale of the 50% interest. And that was about it.
Okay, and again, you did not consider the information provided you to be sufficient proof of a loss for the January 1st, 2018 lien date.
No, I did not. I did calculations which showed that you take away the impairment costs, the goodwill costs, that they would be showing something $60 or $70 million profit for that year.
Thank you. No further questions. My next witness I'd like to call Solicitor Glenn Kirkman. Good afternoon, Mr. Kirkland. You've already been sworn in. You are the assessor for Jackson Parish, correct? And when did you assume that office?
2017.
Okay, so you are the assessor for the 2018 assessment that is being challenged today, correct?
That's correct.
And again, that was a determination of value as of January 1st, 2018, correct?
That's correct.
Have you heard all of the testimony, did you not?
I did.
So the 3 documents that Mr. Smith stated he had provided to the assessors, you did in fact receive.
I did.
Did you review those documents?
I did.
Did you consider them to be adequate proof of a loss in value sufficient to warrant a reduction in value for obsolescence?
I did not.
Did you have an opportunity to meet with Mr. Smith?
Yes, I did.
Tell me about those conversations.
Lasted about a half hour.
Okay.
He went over the information that he presented, made a few statements, just as you heard earlier today in testimony, talking about the contracts expiring in the future, 2020. Did mention the same as you just heard from Assessor Elrod, that the investors in Massachusetts weren't seeing the expected return on their investment. So, felt like that they probably were going to go through with the appeal this year.
Now, the fact that the investors were not making the return they were expecting, is that anything that would factor into your determination of value for property located in Jackson Parish?
No, it's not.
Is the fact that these contracts that they rely on are expiring in the first quarter of 2020, in your opinion, does that impact or does that constitute obsolescence with an effective valuation date of January 1, 2018?
No, it does not.
Okay, is there anything else you'd like to add?
No, sir.
My last witness, I'd like to call Assessor Scott Meredith. Good afternoon, Assessor Meredith. You are the assessor of Caldwell Parish, correct?
Yes.
And you were the assessor. When did you assume office?
2005.
Okay, so you were the assessor when these assessments were made for tax year 2018, correct?
That's correct.
You heard the earlier testimony, specifically Mr. Smith's testimony identifying the three documents that he stated he provided to assessors. That was the financial statement, the impairment analysis, and the purchase and sale agreement.
Yes.
Did you in fact receive those three documents?
Yes.
Did you review those documents in conjunction with Regency Intrastate Gas's request for a reduction in value for
Yes.
obsolescence? Did you consider them to be adequate proof or adequate evidence of a loss
No.
in value for obsolescence? In your opinion, is the fact that Regency Intrastate Gas will potentially, and we don't really know until we get there, but potentially suffer a decrease in revenues in 2020, does that constitute obsolescence
No.
for 2018?
No.
Is there anything else you would like to add?
No.
Okay, no further questions. And that presents our case. Concludes our case.
All right,
Could I address?
yeah, if you want to make a close or whatever you want to.
Yes, sir.
Want to call it, I just ask you to please try to,
Cut through the chase.
just like, 1 minute is great, 2 minutes is okay, but it's not as good as 1 minute.
Real quick,
Music starts to
Judge.
play after three.
First, Brian is a commercial officer. He basically deals with the contracts, so he's not an accountant, so he's a little bit uncomfortable with the stuff, and we asked him to address the contract issue. The $370 million that basically was written down, that included the impairment for the intangible assets and the goodwill. There was still within that 370 was the 234 with the property, plant, and equipment right then. So we wanted to address that. Prior to the lien date, Brian indicates that
Tell me those numbers again, though, that you just
the
mentioned.
370 million on the impairment expense on page 4, which is basically the combination of the write-off of the 17 million in intangible assets.
How much in intangibles?
It was, let's see, it's right in front of it.
119.
It was, the intangible was 19,257, the goodwill was
19 million?
19 million, the goodwill was 119 million, and the balance was the 234. So that 370 included all,
And the 234,
was just property, plant, and equipment.
okay.
Prior to the lien date, Brian, in his role, basically had contacted the other parties to these contracts and had made attempts to renegotiate those contracts. So basically, they had gone to the market and attempted to renegotiate those contracts by either extending those contracts. So the thing is, it wasn't like we were just pulling these numbers out of the air. He had interactions with these other parties to try to renegotiate those contracts because they basically concerned about that cliff coming up. As far as the net income in 2017 of 61 million, that compares with a net income of 2016 of 87 million. So we're starting to see an impact of that. It may be because of the bankruptcies, not really sure, but it's like we're seeing the impact of lower net operating income. Rodney basically did a rate of return analysis. He said it basically 2017, they got a 13.9% return. That's based upon the written down value of 441 million. It doesn't relate to that value prior to the write down. So yeah, 13.9% is a nice return. Prior to that, it was under 8%. So as far as the PwC appraisal, basically not be used for any other purpose than for the company's financial purposes. It's still an authorized report for however the company chooses to use it. It's their I guess, viewpoint of what their assets are worth. So that's why we presented it. The annual impairment test is for goodwill. That's an annual test. When changes occur that would cause you to think that your property, plant, equipment should be impaired, that's where there's some event that happens. But there's an annual goodwill test in that respect. The Riggs Partnership Agreement. If the information wasn't all available in the sale document, I mean, why didn't they ask for additional information? I mean, we tried to go out of our way to provide this information, and the thing is like, I know that paragraph F says that the assessor may request additional documentation. We had no idea that they needed additional information. In regards to Rodney, I know that he indicated that Pritchard Abbott represents Caldwell, Franklin, and Jackson. I know that they represented Caldwell prior to this time. They had another person there, Pritchard Abbott, that was actually doing that Cane Hill appraisal for that big compressor station. We provided this information to him prior to the open book period. So the thing is, it's like, maybe Rodney didn't see it, but his firm saw it. And this is the first time I've heard that he's represented the other two parishes. So, we would have provided it to them all. We felt like we gave it to one, we probably would have given it to all of them. So, I guess the only thing other is that I work with Rodney quite a bit in Texas, and I recognize Rodney has got a lot of experience, and he does a lot of pipeline appraisals. And could I ask you just a few questions relative to this information?
You can question anybody that was called up here as a witness.
Hey, Rodney, I know you've just seen this information in the last few days, but I understand that y'all have had an existing relationship with Caldwell Parish for some time, and the person that we have been dealing with in that respect, I believe, is Steve Thompson. And but the thing is, he never shared this information with you. You haven't seen this, or hadn't been presented this information prior to just a few days ago.
That's correct. I have not.
Okay.
Steve did not discuss any of this with me prior. I get involved with Louisiana in the rules and regulations process. Of course, Pritchard Abbott does work for a lot of parishes for individual properties, but I don't get involved with that.
You do a lot of valuations of pipeline for property tax purposes,
Yes.
both from a local point of view and also from looking at income information relative to some of the pipelines that are either filing a FERC report or an annual, say, financial report.
That is correct.
And do you use income in valuing those pipelines for property tax purposes?
If they are a regulated pipeline that have some financials from a regulatory agency, yes.
You've done that for some that have provided financials, though, that may be not regulated. Is that not correct?
There have been 3 of those in my experience. We only have 1 of them right now. The only reason we did that is because that company sued to have us do it.
Okay. And in regards to using an income analysis, do you use a direct capitalization where you project an income into perpetuity and then divide that by a cap rate to get a value, which is then used to compare with the book values to determine economic obsolescence? Is that a rough approximation?
And yes, and there can be a market approach analysis in there too, so that you can reconcile all 3 indicators that you have.
So in a transaction involving a pipeline, what are investors looking at? I mean, you're capitalizing the projected income. That income is supposed to be what an investor could expect that pipeline to generate going forward.
That's always the case. Any income approach is always about future income, whether it's direct capitalization technique or the discounted cash flow technique.
And so in this particular case, PricewaterhouseCoopers is using the discounted cash flow projection.
Yes, they are.
And even though you pointed out the fact that it's not independent because it's relying on management projections, are those projections, do they appear reasonable to you? I mean, the thing is, who else is going to provide reasonable expectation or projections in that?
Well, again, Mike, I didn't come here today to offer an opinion of value because I wasn't asked to do that, and I had no opinion of value for this pipeline. Management may be exactly correct in their estimates of what's going to happen in the future. I just don't know how much PricewaterhouseCoopers look into
the competitors, they listed the likely competitors that would buy this pipeline. I don't know how much contact they had with those particular likely competitors to know what the market could or could not be if they had folded this particular Regency pipeline into their operations.
Okay, last question. If, after reviewing this information, looking at the throughput information that we have in there, do you believe that there is any economic obsolescence associated with this pipeline in respect to the values that we're using from Chapter 13 to develop a valuation for this pipeline?
Again, I have no opinion on that because that would get back to an opinion of value, and I defer to the assessors on that.
But if you were asked for that, you'd probably ask for additional documentation.
If I had been the appraiser of record, there was a high likelihood I would investigate if that's all that information you provided in more detail.
Thank you.
One question on redirect.
Sure.
Mr. Cracker was on talking about the different ways you can value a pipeline. Are you familiar with the way that most assessors value pipelines in the state of Louisiana?
I believe so.
And what is that?
Well, the rules and regulations have two RCN tables. It's the cost approach.
Okay, and you say RCN tables, those are tables where you plug in the diameter and length of a pipe and it results in a value?
Well, yes, it's a very prescribed cost approach methodology where the replacement cost and new figures are given by diameter size. There is depreciation allowed for based on the age of the pipeline. And then there are further instructions, which I believe is on the screen right now, in Chapter 13 that refer the assessor's obligation to consider the information provided by the taxpayer in writing that would justify economic obsolescence.
And the income approach is not typically used by assessors in the state of Louisiana, is it, in valuing pipelines?
Not for the other pipelines, and I put other in quotes because that's how the name of the Chapter 13 talks about those
Right, and that would be when you said about other pipelines, you mean non-public service
the
pipelines?
non-public
correct?
service,
Which would be,
the gathering and transmission, the non-interstate transmission pipelines.
which would be the entire universe of pipelines subject to assessment by assessors, correct?
Correct, if there is specifically the exclusion of lease lines.
Well, and this, of course, the third approach of value is the sales approach. But you earlier testified that the information provided to the assessor, the Alinda sale, did not meet the criteria for a valid sales approach valuation, correct?
Well, I had my misgivings about much of the information, but I defer to the assessors and their consideration because it's their job to consider it.
Thank you. No further questions.
If I could just wrap up.
Two sentences.
With or without this.
2 sentences.
Real quick, we believe we provided credible, supportable evidence of economic obsolescence, whether it's 31% or not, is up to the assessors. But we were somewhat amazed that there were not more questions or requests for additional information in support of what we provided. So appreciate y'all's consideration.
Thank you.
I think I give a 2-sentence summation, maybe one. The fact that Regency has demand contracts for which they're receiving 80% demand payments to this day will be expiring in 2020 does not represent obsolescence for a 2018 valuation.
Good. All right.
One long sentence.
Well, very long. Thank you all very much.
Thank you.
Appreciate your presentations. We're going to take this matter under advisement. Obviously, it's a rather complicated appeal, and we're going to take it under advisement and act on it at the appropriate time. So, thank you all very much. So,
Is that a motion?
you make a motion. You going to second my motion?
Second.
You second that motion. I'm going to take it under advisement.
Thank you, Commissioner.
Thank you.
Call the roll.
Other questions?
Commissioner Barcher,
Yes.
Commissioner Wagstaff,
Yes.
Commissioner Wood is absent, Commissioner West,
Yes.
and Chairman Shahar.
Yes. The tax commission hereby accepts all pre-filed documents and oral testimony into the record as taxpayer exhibit 1 in Globo, assessor exhibit 1 in Globo, and Louisiana, and for each appeal hearing conducted here today. All right, we'll now consider.
Thank you.
Thank you.
Thank you. Right.
right, the next item on the agenda is the consideration of change orders.
Good morning, Commissioners. Meridian Ponche on behalf of the Louisiana Tax Commission. Today we have a total of 279 change orders. Staff has reviewed those change orders and request to approve 262 and 317 in pending. Staff requests approval of these change orders.
Do you have a motion?
Make a motion that we approve the 262 change orders and put 17 in pending status as recommended by staff.
Second.
262 or
Approved
262.
262. A total of 279.
Do I have a second?
Second.
Commissioner Barcher?
Yes.
Commissioner Wagstaff?
Yes.
Commissioner Wood is absent. Commissioner West?
Yes.
And Chairman Shahart?
Yes. We'll now consider prior pending change orders.
Meridian Ponche on behalf of the Louisiana Tax Commission. Today we have a total of 23 prior pending change orders. Staff has reviewed those change orders and requests to approve 13 and deny 4 in Orleans Parish per assessor's request, with 6 remaining in prior pending. Staff requests approval of these prior pending change orders.
I would move that we accept the staff recommendation and of the 23 prior pending change orders, approve 13, deny 4, and place 6 back in pending status.
Second.
Commissioner Barcher?
Yes.
Commissioner Wagstaff?
Yes.
Commissioner Wood is absent. Commissioner West?
Yes.
And Chairman Shahart?
Yes. We'll now consider tax sale cancellations.
Tanisha Malvo on behalf of the Louisiana Tax Commission. Today we have a total of 4 from St. Tammany Parish. The reasons are as follows. 1, the property was actually 2, where the property was subdivided and sold prior to 2009, making it a wrongness listing and dual assessment. We have 1 where it was also a dual assessment, and the last one, it was a erroneous listing. The 1.29 acres were also prior to 1983.
Staff requests approval of these tax sale cancellations.
Thank you. Do we have a motion?
Motion to accept the request of staff for the tax sale cancellations of St. Tammany Parish. First one for erroneous listing and dual assessment, the second for the same, third for dual assessments, and the fourth one just erroneous listing.
Second.
Commissioner Barcher?
Yes.
Commissioner Wagstaff?
Yes.
Commissioner Wood is absent. Commissioner West?
Yes.
And Chairman Shahart?
Yes. All right, we now have the consideration of 2 requests for a refund of taxes paid in error. Mr. Hoffman.
Morning, Commissioners. Drew Hoffman, Special Counsel for Louisiana Tax Commission. As the Chairman just pointed out, we have 2 refund requests in the docket this morning. We'll handle them both in turn. First one is from Livingston Parish. The taxpayer is Heartland Investors. It's a request for refund of taxes for years 2013 through 2017. The request is somewhat vague, but it appears the taxpayer is complaining about the legal description of the property when it was purchased at tax sale, and it appears they want to undo the tax sale and want to refund taxes. The assessor's response is deny the request and notes that this is a tax sale issue, the property was sold as is. Despite the ambiguity in the request, since the assessor indicates that we should deny the request, my recommendation is to you that we deny the request on the basis of the statute. It indicates that if the assessor does not agree with the refund request, we cannot approve it.
Make a motion we deny the refund request by Heartland Investors in Livingston Parish.
Second.
Commissioner Barcher?
Yes.
Commissioner Wagstaff?
Yes.
Commissioner Wood is absent. Commissioner West?
Yes.
And Chairman Shahart?
Yes.
The next refund request on the docket is from Orleans Parish. The taxpayer is 1438 North Claiborne LLC. It's a request for refund of taxes for the 2017 tax year. Again, this request is somewhat vague, but it appears that the taxpayer wants a refund of taxes paid on the basis that an age freeze was removed. The assessor has since reinstated a homestead exemption, but not put the age freeze back on, because the individual who qualified for the age freeze is deceased. And the heirs of the property have now taken possession, and although they qualify for a homestead exemption, they don't qualify to reinstitute the freeze. Even if they did, the property would still be reassessed. The freeze wouldn't carry over to the previous owner. All of that notwithstanding, the assessor's response to the refund request is that we should deny the request. So again, notwithstanding the ambiguity of the request, since the assessors indicated that we should deny it on the basis of the statute, we have no choice but to also deny the request.
Do you have a motion?
Make a motion to deny the request as per request by the assessor.
Second.
Commissioner Barcher?
Yes.
Commissioner Waxback?
Yes.
Commissioner Wood is absent. Commissioner West?
Yes.
And Chairman Sharp?
Yes.
There was no succession in it.
We'll talk after.
Yeah, let's talk about it.
All right, there being no other matters to come before the commission at this time, I'll accept a motion to adjourn.
So moved.
Second.
Commissioner Barcher?
Yes.
Commissioner Waxback?
Yes.
Commissioner Wood is absent. Commissioner West?
Yes.
And Chairman Sharp?
Yes.